Hey traders, it's Blake Morrow with Trader Summit, and we are with Jim Welch because it's Friday. It's good to see you, Jim.
Great to see you, Blake.
And I forgot to
That
mention,
means we survived another week.
survived another week. It's Jim Welch from Macro Tides. Just make sure Macro Tides, like a wave, because he lives in California. There we go. Just make sure you guys all have that fresh in your mind. Hey, Jim.
Yeah.
So next week's a big week. Not only is it a big week with earnings, we have a lot of big tech names are coming to the forefront. A lot of big names just across the board. We have the Fed next week. We have the Bank of Japan. We have the European Central Bank. We have a lot going on, and it's summer.
Yeah, and it's summer. Well, you're 100% right. Again, the Fed is going to raise by 25 basis points. At the same time, I think Powell is going to continue to sound pretty hawkish. He's not going to commit to we're going to go every other meeting idea, even if that is somewhat maybe the bias at this time. It really comes down to the data points that they're looking for in terms of the economy slowing meaningfully haven't materialized. The labor market, is easing around the edges, but not, materially. So I just think he's going to sound pretty hawkish. And in a sense, we'll see the percentage of a September rate hike go up when he's done. That would be my guess. I don't know that that's good news for the markets. And as we get into the stock market stuff, it kind of potentially could play into, an inflection point at this point. So anyway, and the ECB is going to raise rates. I think some of their tone might back down a little bit because they've seen pretty big drop in some of their inflation data. And the Bank of Japan is likely to keep singing the same old song.
Yeah.
So
it's going to be an interesting week next week, but you brought us a bunch of charts. And so you told me ahead of time, we're going to get through this stuff really quick, but I'm a little skeptical when I saw your chart pack. So before we get into those, let me just mention that if you like what Jim does here every week, make sure you subscribe to this channel, but give him a big thumbs up and jump in the comments. I know some of you have been doing that. And Jim, I know there are comments coming in the comments section. So if you have any questions, especially on these charts that he's bringing a lot of them today, that make sure you get in there and chat with him about it. All right, Jim, let's get in.
And I'm going to interject one thing.
Yeah,
as
please.
you know, for viewers of Trader Summit and our videos, I offer a 20% discount on a subscription. So macrotides.com, or if you'd like a recent issue, Jim Welsh Macro at Gmail. I just wanted to do that at the beginning, because
some people cut out at the very end and they miss that. Yeah, they missed that. You do that.
They're missing a big deal.
Yeah, it is a big deal. It is a big deal. Well, you know what? What's a big deal is this chart of the LEI that you have here.
Yeah.
Tell me why we're looking at the LEI. And I this was a big headline like yesterday or the day before yesterday.
Yeah, it was. And we've talked about this, and shown, if not this exact chart, similar, down 15 months in a row. And what you can see is the degree of negativity in this chart is highly correlated. If you go back, like 50 years, plus years, with recessions. There's always a lag time. That's why it's called leading economic index. And it's suggesting that I believe in the next 6 months, third quarter, we're going to see things slow. Fourth quarter, that slowdown is going to accelerate. So we've gotten to the point where if anybody on, CNBC talks about leading indicators or the inverted yield curve and, they kind of tell us they're kind of derided. Like, get out of here. We're so tired of hearing you guys talk about recession. And I get it, because for, most of the last year, economists were talking about a recession, especially last summer and fall. And now we're to the point where most people are like, hey, if it hasn't happened, it's not going to happen. I believe it's just a question of when it's going to happen, not if. So This is just reinforcement to the viewpoint I've espoused, is no recession in the first half of 2023. The second half, we would see slowing. And, this just continues to kind of provide that message. The second chart is interesting because the conference board also provides a coincident indicator. So the other one's leading. This is coincident. So in other words, it's going to turn negative and turn down closer to the onset of a recession than the leading index, right?
Okay.
And the thing is that it was flat in this last month for June. And you can see it's the lighter blue number that's under the darker blue number for most of this chart. And, it's consistently been creeping higher. And now we're finally really seeing it flatlining. So to me, that is just, again, reinforcement that more and more of the data points are starting to show softening. And the next thing that's going to happen then is actual weakness. The thing in the leading index that has been holding it up better in June was a 20 basis point increase in the stock market, but also a number of the labor statistics that are in the LEI. Again, I think we're on the cusp of seeing unemployment claims start to rise meaningfully. Ultimately, by the end of this year, the unemployment rate is going to be going up. My point being is some of the data points that have been supportive of both the coincident and leading indexes, I think those are on the cusp of showing weakness. So the table is set. Now we just have to wait for the data points to actually come in and confirm. And my confidence is high that between now and year end, that's what's going to happen.
All right. Well, the next chart you brought is a lending standard. So this is something that you've mentioned quite a bit here. Yep. That they tighten. Are they continuing to tighten?
Well, we won't know until the first week of August. They'll come out with the second quarter numbers in the first week of August. And I'm only showing this chart because it's cool because it overlays with GDP. And so you can kind of see how lending standards correlate with GDP. And again, there's a lag time to this as well. I think the next 6 months, as more and more small businesses, medium-sized businesses that rely on bank lending, their loans come due, they're going to get a little bit of an interest rate shock, and they might get a little bit of a liquidity shock. There was an item out this week, Blake, that they've been keeping this data since 2013, so it doesn't go back a very, very long time. But the rejection rate on auto loans jumped from like 9% to 13%.
That was a big headline this week. Yeah.
To me, it was because, again, one of the strengths that's been happening is, auto sales have been holding up, getting a little bit better as inventories improved. So, again, the impact on the consumers is going to become progressive, and it's going to be a negative. So, again, lending standards are a big deal. It just takes time for them to really take hold. If the consumer is getting less lending, well, that removes demand from the economy. It's that simple. And this chart shows what's coming.
Makes sense. All right. Then the next chart you brought is unemployment versus job openings. So tell us a little bit about this chart and why did you bring it to our attention?
Well, again, the labor market is key, I think, for the Fed and its policy. Obviously, for the economy, people start losing jobs, demand suffers, economy slows. And what this chart is looking at is job openings in the National Federation of Independent Businesses surveys. And then they advance it 11 months. Idea of it's a forward-looking indicator. So what it's showing is that small businesses are pulling back on in job openings. They're declining. Well, what's happened in the past? Well, 11 months later, you start seeing a tick up in unemployment and the duration of unemployment. And this is something we talked about a couple of weeks ago. You start seeing unemployment claims slowly but surely start to rise. And the continuing claims stay, if you will, relatively low, because when the economy is still doing okay, somebody gets laid off, but they find a job within 3 months. But you get to a point where unemployment claims start to go up and exceed the economy's ability to absorb that additional excess labor, then the unemployment claims, the continuing claims, really start to pick up. And that's kind of what this is saying, is this is what's coming. We're going to see more people laid off. The duration of the period of being unemployed is going to increase. which naturally means the unemployment rate is going to go up. So these are all in motion. It's not like, well, this might happen. No, this is going to happen. The only thing we don't know is the degree. Is the unemployment going to go from 3.5% to 4.1, or as the Fed projects, 4.5% sometime next year? So again, those who are not, have jumped from, oh my God, we're going to have a recession, to, no, I'm not worried about a recession anymore. These are the things that tell me that we're going to see a significant slowing, at least 1 quarter of negative GDP growth. And I think the odds as we get into next year, the odds are we're going to have a real recession. So these are the data points that run counter to the narrative that's been driving the stock market. The idea that, hey, we're not going to have a recession. Earnings are going to rebound from the second quarter of this year trough and then begin to increase. So if this information is correct, that narrative is going to get challenged.
Okay, well, you brought up the S&P and you brought up the stock market and how bullish it's been. You got a couple of charts regarding the S&P. So what are we looking at here? You got this one's you're looking at the days, the number of days.
Yeah. So if you take the amount of time the market went down, peaked January 4th of last year, bottomed October 14th, 283 days. Then you take the number of days from October 14th when it bottomed, project out 283 days, it's July 24th. So, this stuff isn't like perfectly precise, but it kind of tells you just in terms of markets do have this tendency to go down and up in equal amounts of time. So we're time-wise entering a pretty critical period. Pattern-wise, as I talked about last week, is that the decline from the January 22 high to the low last October could be a big wave A in a much bigger bear market, so that this recovery isn't the beginning of a brand new bull market that's taking the S&P to 5,400 or even higher. It's a B wave. And price-wise, the 786 was 45.34. We've gone about 1% beyond that. Two legs being equal was 45.12. So you've got measurements that tell you you're in a window, price window, that could also mark the end of this rally. So we have time, we have price. It just, to me, says, okay, we're really at a juncture here that at a minimum, I'm expecting at least a pullback to 42.50 between now and potentially Labor Day.
It's interesting you bring this up. I'll follow some of the bigger names in the markets, and I've pushed back against a lot of people saying that we're going to have some sort of blow off top, because when you see Microsoft giving us a false breakout after hitting all-time highs, you got Apple's in an ascending wedge, and it's rejecting that wedge. It's still in breakout territory, but it looks more of a bearish setup than a bullish setup at this stage. You start seeing big names like that. It's hard to get on board with, hey, we're going to have this big blow off top. Maybe it will come, but it's getting tougher when some of those key components are not playing ball. And then,
and they have a large weighting. That announcement
is
by Microsoft in terms of their version of some spiffy thing is expected to generate $10 billion in revenue. It added $130 billion of market cap. So that again reflects the enthusiasm that's out there. So if I thought that the economy was going to be holding firm or getting a little bit better, it would cast real doubt on this B wave idea. If I thought the Federal Reserve was very close to that, legitimately, I could say, you know what, in 3-4 months, they're going to be cutting rates. It's just the opposite. They're still leaning towards raising rates. Plus, they've repeatedly told us they're not cutting rates for a long time. So as higher rates dig in and cause the economy to slow even more, it's just tough for me to go into the blow-off idea as well. At the same time, there has been an improvement in market breadth and a couple other things. But the other thing is sentiment reflects some of this enthusiasm. So this is the National Association of Active Investment Managers. And I could have shown the call put ratio. I could have shown investors' intelligence, the American Association of Individual Investors, people calling for new all-time highs. Anyway, what this shows, the top panel, is their exposure. It hit 99% in the last week. Well, the only time it's been higher was in November of 2021, which, oh, by the way, that's when the NASDAQ peaked. Remember, the NASDAQ peaked in November 2021. The S&P peaked in the first couple days of January of 2022. So my point is, we have, 6-8 months ago, positioning was light. As you go back to that October, back in October, you can see they had less than 20% allocated to the market. Now they're at 99%. The market, of course, has worked its way higher as that exposure increased. So you've got a lot of people that are already in the market, and sentiment is pretty high. I mean, the call put ratio, Blake, is higher now than any time. I think it's higher than it was in November 2021.
Yeah.
So, so to me, again, these are all things that are coming together when we have a time frame thing, we have a chart pattern analysis of the S&P, and sentiment is all coming together. The last piece is momentum. And the momentum has been good. At the same time, I use a 21-day oscillator of net advances and minus declines. It's overbought. And what we can see is the recent high in the last few days, the breadth was just a little bit weaker, not conclusive in and of itself, but it's showing the market is overbought, and we're starting maybe to see the thrust of momentum beginning to lose some of the upside momentum. So for me, the message is clear. We're near a high of some magnitude. Is it just going to be a 5%, 7% maybe pullback, or is it going to be something more? In the short term, it's probably going to be in the 5% variety. People need a reason to sell. And I think that we'll get that reason as time unfolds between now and year end, and the economy shows signs of slowing. In the near term, buying the dip, the idea of no recession and all that, that's going to continue to hold sway in the near term. But if I'm right, economy shows signs of slowing, then that becomes problematic. And you can look at this chart and you can see the high that we saw in February, we were overbought. Last August, obviously overbought. And late November, early December, just about overbought. So, even the April, May, instead of a pullback, we just went sideways. That is unusual. Normally you'll see more of a price pullback, and that's what I'm expecting this time. Okay. I think we're going to see the market pull back. Now, the question is going to be, in the near term, as people unload maybe some of the mega cap stocks, Blake, what we saw this week, what was interesting is utilities started to rally. Healthcare, those are defensive sectors, but they've been down and out all year.
Yeah.
It's just, to me, I had a call with a group of advisors last week, and what I recommended was utilities, healthcare, and natural gas. And, again, just looking at the stuff that hasn't worked. So that, to me, is kind of interesting that we're seeing defensive sectors that have been down and out all year. I mean, I think they're both negative on the year, beginning to show some life.
And, it's interesting you say that, Jim, because when you have rotation, everybody's been saying that it's like, okay, we're going to get some of the money coming out, you rebalance, you're going to get money coming out of these bigger tech names into different sectors, which is happening. But what you're pointing out is it's coming into the defensive sector, which may also be another tell that you should be paying attention to.
I mean, industrials have done well over the last couple months.
Yeah.
So, there is broadening out, and some of it, again, is to economically sensitive sectors. Again, the belief, no recession, these things are going to do great. If we do have a slowdown, they're going to be great next year. So in the near term, that will help the market not get beat up in a meaningful way. I saw a chart of the correlation between sectors. It's at an all-time low, which underscores kind of what we've observed in terms of this rotation. different market averages moving up or down relative to others, and it's all disjointed. We've seen the Russell have a pretty good pop. Well, I think that's running out of gas. So we're at this point where the transition is likely to have a pullback, some choppiness before I think more meaningful selling pressure will develop when we actually see signs that the labor market's truly weakening, the economy softening, and so forth. You need to challenge the narrative that's been lifting the market really since last October's low, and especially from the April, May, after the regional bank thing hit in March. The other thing too is the Fed's balance sheet got a big injection, a big boost in response to the regional bank thing. Well, now the Fed's balance sheet is below where it was in March. So there's a lot of things in the background that, to me, have the potential to contribute to a more meaningful decline, but it's one step at a time. Yeah. Right now, I just think the market's at a juncture where fading strength, raising cash makes sense. For the crazy folks taking a short position, in anticipation of at least a 5 to 7% pullback, I think we're there.
All right. Well, speaking of raising cash, you talk a little bit about the dollar. The dollar got hit last week, and then this week it's recovered a bit. So, yeah, is this a viable recovery? I mean, what do you think?
I'm not sure. We had talked weeks before that dump last week that a triangle pattern is going to drop, get down. I thought below 99. I think it got to 99.58.
Yeah.
Last week I noted, you can see the RSI panel at the bottom of that chart was down to like 24, 25. We were going to get a bounce. It carried, I think, like to 101.18 maybe this morning. It may go a little bit more if Powell is pretty hawkish. I'm just not convinced that we have an intermediate low in place, as opposed to, we got hammered and we're getting a reflex bounce because it got so oversold. I just think for now I'm just like neutral. Thought we'd get a bounce, fine, but I can't. For me, I have nothing to say, gee, it's not going to, I don't think it's about to fall out of bed, but it's hard to see how it's going to rally significantly from where it is right here.
I had one of the gentlemen that I've done a couple interviews with. He brought up something to me that I actually missed this last week, and it's something I'll talk on my weekly video over the weekend. But this move here is an equal leg move. That's that actually, and I can't believe I missed that one. And so
that's a good point, because you've got company.
Yeah,
I didn't look at that. But what that implies is you're going to get a bigger rally, because I don't know what his interpretation was, but that rally to wave A, as I have marked on the thing, big wave A. Well, then this would be an A, B up to the C, and then another A, B, C down for like a B wave. Well, that implies that you're going to get a pretty good snapback. I would say potentially 104 becomes a target under that scenario.
Oh,
it rallied about 5.5 points. So, that's an interesting thing. I think, as we get towards later August, the Jackson Hole speech, a lot of people, I think, would be like, well, maybe Powell's going to signal a pivot, or give some indication that policy is going to be easing up. I don't think that's going to happen.
Yeah.
So
it's good that you bring that up.
That's an interesting thing that the guy pointed out to you, because it kind of jives a little bit more with how oversold the market is. And I think people are to think that Powell is going to back off and other Fed members are going to really materially back off. Don't see it, man. The data, what they're looking for, hasn't shown up yet enough. Yeah, the inflation's come down, but the inflation that they pay attention to is the price consumption, the PCE expenditure index.
Yes.
That hasn't come down a whole lot. It's going to continue to come down, but they want to have confidence it's going to 2%. And the only way they're going to have confidence is if the unemployment rate's above 4. Then they'll know that, okay, lasting improvement is happening.
And I believe we get that PCE after the Fed next week. I believe it's on Friday, if I'm not mistaken.
Yeah, it's always like the last few days of the month. So next Wednesday and then Friday.
So gold, what do you make of this? I mean, I've Jim, I've been in the camp that gold should have done a lot more with the weakness that we saw in the dollar. I really believe that gold should have been trading well above 2000. It really is kind of languished. And
could you shrink the chart a little bit, because there's something on the far right that I want to okay. So the expectation, for weeks, in early May is like, okay, we're going to have a pullback. We had wave one up from 1616 to 2059. We're going to get a wave two pullback. The 382 was like 1892. It got to 1894. And then you can see there's 5 waves up from that low. 1, 2, 3, 4, 5. So that's from Elliott wave. There's 2 charts. It's either a 5 wave for an X wave, and then we're going to get another A, B, C down, or it's 5 up for wave 1 of what would be wave 1 of wave 3 to new all-time highs. It's one or the other, okay? So if the dollar rebounds more, then in my opinion, that would add credibility that we'll see that gold drop below 1894 and another ABC. The bigger picture is once this wave 2 correction is over, whether it already bottomed, because you got 5 up, it could be wave 1 in the next up move, or a deeper correction takes hold south of 1850. The main message I've been trying to convey is once this correction's over, I think gold's going to new all-time highs. 2300 to 2400, I think, is coming. So it's just the near term is foggy. So we want to see what kind of a pullback. Again, if the dollar makes a move up closer to 104, I think that favors a deeper pullback in gold.
All right. Well, the last chart you brought is of TLT, and rates. It seems like is driving the market right now. We've seen TLT get up towards trendline resistance. Also, if you're looking at like the 10-year, this happens to be a 618 retracement of this move, so it's a lot of resistance around here. I mean, what do you think? Are we going to break it?
I don't know. I mean, again, longer term, I think the economy is going to slow meaningfully. I think TLT has the potential to rally to 115, 117. There's the potential that we had a wave A high last January, February from the low last October. And this choppy period ended when TLT traded down to 98.85. All right. End of the big ABC, B wave, kind of like, what we just went through on the dollar. It implies then that we're beginning at the very early stages of a C wave that gets you up to 115, 117.
Yeah.
What I don't know, at the same time, you're below that blue trend line. So if Powell talks tough, let's see what kind of a pullback it has. But my bias is to look for a place to go long TLT, because I think ultimately we're going to see at a minimum a rally back to that 109 area.
Got it.
At a minimum. And then if it breaks out above 110, then you're going to 115, 117.
It's easy to look in this environment and say, oh, we're in a, especially when you're dealing with dollars and you're dealing with the bond market and yields. You're like, oh, yields are going down, the dollar is going down, or yields are going up, the dollar is going to go up. But there is a time and place for the dollar and bonds to go up at the same time, and yields to go down and the dollar go higher. And so
I saw a chart, to your point. It's a great point, that historically when the U.S. goes into recession, you would think, oh my God, the dollar must go down.
Yeah.
No, on balance, it goes up. So, what happens in a recession? Yields come down. And in this case, the dollar has historically gained. And I think part of it is if the U.S., used to the old saying, when GM catches a cold, the U.S. gets sick or something. I don't know, sneezes and the U.S. gets sick. Well, the dollar, if the U.S. goes into a recession, well, the global economy is probably not in great shape. And, more so now because monetary policy has become much more coordinated than 30, 40, 50 years ago between all the different central banks.
Yeah.
So we've seen banks obviously raise interest rates, lending standards not only have gone up here, but in Europe. China's trying to get their economy out of the doldrums without a whole lot of success so far. So sometimes, the dollar may look like the less dirty shirt, or whatever that expression is,
yes,
relative to other parts of the world.
The other dirty shirts.
We're in an environment where you just have to, I think, use technical analysis, and keep your head on a swivel. You know,
and growth is going to
possible,
matter, right?
Data points coming up. I'm sorry.
Growth is going to matter. Growth is going to matter. Whether you're
Always
talking about
matters.
stocks or you're talking about economies, it's going to matter. Hey, Jim, I follow you on Twitter, but how do other people follow you on Twitter?
I think it's at Jim Welsh Macro.
Okay. And
yeah.
What's the best way for them to follow your work directly?
Macrotides.com. And if you really want it right from the horse's mouth, become a subscriber. I'll be happy to send you a recent issue, Jim Welsh Macro at Gmail.
All right.
Well, you're a great setup, man.
Hey, and I know you give 20% discounts to Trader Summit listeners. So make sure you mention that when you contact Jim. Jim, I love having you every week. If you love having Jim here every week, give him a thumbs up. Make sure you subscribe to this channel. This is exclusive content here at Trader Summit. Jim, I hope you have a great weekend. I hope you stay cool there in Southern California.
It's more challenging for you, Blake.
It is.
But have a lovely weekend.
Thank you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.